Right, before we get on to auditing subsequent events, let's just be clear in our mind what a subsequent event is. So let's say your year end, your reporting date is the 31st of December, and the day that you sign your audit report is 6 months later on the 30th of June. Let's say. It's probably going to be a lot longer than that. But anyway, in between that, you have what we call a time period where you could get some subsequent events. Subsequent meaning subsequent to the year end. And you've got to decide whether those subsequent events have been identified and have we adjusted for them or not appropriately. Now, you do adjust at the year-end accounts, because you have to remember the year-end accounts are at the year-end, obviously. So you only adjust a subsequent event, subsequent to the year-end, if it gives you more evidence about the conditions at the year-end. If it gives you more evidence about conditions post-year-end, you don't adjust. Now, what you may do, though, is disclose, but we'll look at that in a bit. So let's say that a debtor goes bust on the 5th of January. That's obviously a subsequent event. But does that give you more information about the debtor at the year end? Let's say it was a debtor of $10 million and it goes bust on the 5th of January. Does it give you more information about the condition of the debtor at the year end? And you have to say it does. It's probably the hardest one to understand because it just seems, well, it was on the 5th of January, it was post year end. Well, it is, but it gives you more information about the year end. What about this one? A fire on the 20th of January, all inventory destroyed. Well, that fire was post year end. Does it give me more information about the year end? No, it doesn't. The inventory was fine at the year end. So at the last one, the debtor, we would put in a bad debt at the year end because it was probably quite a bad debt at the year end anyway if it went bust 5 days later. As far as the inventory is concerned, the inventory was fine at the year end. The fire was 20 days later, so it was fine at the year end. So you leave it in the accounts, do not adjust, but what you would do is disclose it. Because you're saying to your shareholders, look, at the year end, the inventory was worth 10 million, but there has been a fire post year end and it's now worth nothing. So that would be a disclosure rather than an adjustment. What about this one? A dividend declared on the 18th of January. So it's been declared on the 18th of January. At the year end, it hadn't been declared. This is a subsequent event, no adjustment. Okay, so let's recap. Your subsequent event period is the date between your reporting date and the date of the audit report from an auditor's point of view. So you look at subsequent events there, you say, first of all, an auditor's got to make sure that because it's the management who does this, isn't it? The auditor has to make sure that the management have identified all subsequent events and have adjusted for them or not appropriately. They should have adjusted if it gave them more evidence about conditions at the year end, and they shouldn't adjust if it gave them more evidence about conditions post year end. But maybe, like with the inventory example, they would disclose. Now, we've got to make sure that they've identified all the events and accounted for them appropriately. So, there's a subsequent event review that we might do. And all the subsequent event review might do is just say, right, I'm going to review the audit file and I want to make sure that we've identified all the events, we've adjusted for them correctly, and so I want to see in this subsequent event review sufficient and appropriate evidence that we've identified the events, that the management have adjusted for them, and so that I can say the financial statements are true and fair and up to date. Incidentally, if we find an adjusting event that they refused to adjust, then we would modify the audit report, wouldn't we? Anyway, how would we get this sufficient appropriate evidence? This is where students normally struggle with subsequent event procedures. So I'm going to go through a list of procedures and then I'm going to give you a great memory tip at the end. So to identify a subsequent event, you'd probably review the board and the committee meeting minutes after the year end, wouldn't you? To have a look, has there been anything in that subsequent events period that we need to know about? You'd inspect the latest management and interim accounts, because the interim accounts will be in the new year, to look for any big changes, material movements. You would look at post-year end cash books and bank statements. Have we had some large receipts? Did we miss off a debtor? Did that debtor pay? Okay. You would examine post-year end sales returns and credit notes, because you might have put a huge sale in, but then if they returned it in the post-year end, it wasn't a sale in the first place, was it? So looking for inventory obsolescence as well. So there's all these different things that we need to look at. Interim accounts, minutes, banks, or credit notes, all sorts of different things we need to look at. And then we also need to inquire of management, like, has anything ever happened? We need to ask them that. We need to get confirmation off lawyers if there's any outstanding litigation. What's the position at the year end? And not only do we have to ask management, we have to look at press releases, the website. So go and show some professional skepticism. They may not have told us anything. So look for significant matters in the new year. Look at post-date debtors and suppliers payments. Yep, so make sure suppliers and debtors were right at the year end. Analytical procedures, are they showing any differences in trends that may point to something being a bit weird? And always do this, get a written representation that says, look, it's your responsibility. So ask the management to write out, it's my responsibility to tell you all the subsequent events, and they have done, but that's not ever sole evidence. You have to do all these other things that I'm suggesting. If the audit report is delayed, then your subsequent events period is extended, isn't it? Always remember that. So you have to do more work up to the audit report date. Now, all of that is quite difficult to remember, isn't it? Can you remember the first one was look at committee and board minutes post-year end? So as long as you can remember that one, you've got a good chance of remembering the rest, because I've created this mnemonic for you using the word minutes. So not only is minutes the first one, but the second one, have a look at the interim accounts, as we said. That's the I, the N. Have a look at the news and press releases post-year end. The U. Have a look at unusual cash movements, unusual trends. The T. Talk to management on those charged with governance. Inquire of them. E. Get some external confirmations from the bank. Look at bank statements. Look at legal letters if there's an outstanding claim. And finally, S. Do a subsequent analytical review. So that's a way, there's more, isn't there? But that's a way of remembering, this is going to really help with your subsequent event procedures. Some common pitfalls flagged by the examiner. What do we do wrong that we don't want to do wrong ourselves then? Say in written representations only, you do get written representations from the management that it's their responsibility, but it's supporting evidence only. Some students forget the period. Remember, it must cover from the financial statement, the reporting date, to the auditor's report date, not the AGM. Don't just list everything out, don't just write the minutes down and not relay it to the scenario. And don't forget about disclosures. So even if an item is non-adjusting, it might be material to users and might require disclosure. Okay, hope it helps.